Welcome to Eagle City Multifamily, where we discuss all things apartments. But first, I wanted to say this is not legal or financial advice. It is simply professionals sharing their knowledge and how they got into apartment investing. Today, we have an amazing guest, Mike Roeder. So welcome, Mike.
Thanks so much, Herb, for having me on. I appreciate it. Looking forward to this.
All right. Yes, let's have fun with this and share to people that maybe are interested in getting into apartment investing. Maybe they heard about apartment investing and are interested in especially passive investing is a very great way to, once you know the teams that you could potentially partner with and invest with. That's a really important thing, is to learn to know the team that you're investing with. So Mike, if you don't mind sharing a little bit of your background story and what you've done and how you got started in apartment investing.
Certainly, I'd be glad to. So it starts way back in 2009. I purchased my first single family home. My girlfriend, now wife, and I lived in one of the bedrooms, and we rented out the other three bedrooms. So we house hacked our first property, and we just fell in love with the cash flow. You know, we were maybe 20 years old or so at that time. And shortly after that, turned that into a full-blown rental, bought another property that we lived in. And then we started stacking single family rentals in my hometown where I lived, which is in central Minnesota. And so that's where we really fell in love with the passive income and real estate investments. And fast forward about, 3 or 4 years, I teamed up with my now business partner, Dan Breezy, and we purchased a 20 unit in my hometown. And then we purchased an 8 unit right across the street, all multifamily. These were C-class properties, 100% occupancy. They were kicking off, tremendous cash flow. And that's where we really fell in love with multifamily because, one, it gives you more cash flow. 2, you're able to spread the risk across multiple units, and you're able to scale a little bit quicker as well. So that was our first multifamily project. And then we decided that we wanted to go the syndication route. So we had a lot of people asking us, hey, how can I get involved? Can I invest in one of your projects? We want to build up our passive income. And so we built out our team, we found a mentor, and we started syndicating projects about 5 years ago. And so what syndication means is you're basically buying a bigger property and you're pooling people's funds together to buy that property. And other than my real estate background, I was a high net worth insurance producer. I did that for about a decade, very enjoyable career, but happy to say that I've been a full-time multifamily investor for a couple of years now.
Wow, that's a great background story there. Yes. Would you mind going into the tax savings of apartment investing for passive investors, especially?
Certainly. So there are a ton of tax savings in multifamily for passive and for active investors. So let's talk a little bit about the passive side. So when you passively invest in a project, what the sponsors or the general partners that are putting the project together should be doing is they should be doing what's called a cost segregation study. So they hire a specific firm that's very educated in this, and they're a professional company, and they come in and do what's called a cost segregation study. So they basically segregate the different pieces of the property. So the sidewalk and the cabinetry and the carpet and the framing and the roofing. And they determine what pieces of that property are 5, 15, and 27 and a half year properties. So how quickly can those pieces be depreciated? And what happens is you're able to depreciate the property significantly quicker than how quick you could do it without that cost segregation study. And with the tax law, the way that it's written right now, it states that, I believe, and check with your CPA, obviously, on this information, but the items that are less than 27 and a half years, you're typically able to depreciate those in year one, 100%. So things like your sidewalk or if shrubbery has been placed, landscaping type of items have been placed on the property, or your cabinetry or your carpeting, you're able to depreciate those all year one of ownership. So what you see a big depreciation loss year one of ownership on these multifamily assets, which really helps alleviate you having to pay income on or pay taxes on your income that you're bringing in from that property that year. And then also sometimes you can offset other income, capital gains, business income, sometimes your W-2 income if you're a real estate professional. So it can be very, very advantageous.
Wow, that's valuable information. And I hear a lot about bonus depreciation. And have you dealt with that much, or?
Yep, definitely. So bonus depreciation, again, that refers to the items on the property that can be depreciated 100% year one of ownership. Now, 2022 is pretty special because we're still allowed to depreciate at 100% for those items. However, next year it starts tearing down. So I believe it goes down to 80% in 2023 and then 60% in 2024 and so on. Tax law may change. They may bump that down the road, but that's where it sits right now. So 2022 is very advantageous to get into these multifamily properties for the bonus depreciation benefits. Now, again, what we're seeing typically is if someone invests, let's say $100,000, because of the cost segregation study and the bonus depreciation that we're allowed to take advantage of, you'll see, likely around a $40,000 to $70,000 depreciation loss year one. So again, if you invest $100,000, you'll probably see about $40,000 to $70,000 in losses year one, which you can help, offset your income or your capital gains or whatnot, which is really beneficial.
Great. Awesome. Yeah. So it's really been great knowing you. We've probably known each other for the last year and a half or so, right?
Exactly. Yeah, it's been wonderful.
Yeah. So, and I've seen a lot of your projects, and it's amazing what you and your partners are doing, and all the opportunity that you give to your investors to invest with you as well. So that's amazing to watch you grow.
Thank you. I appreciate it. And it's great to give people that opportunity to invest in real estate, because a lot of people out there, don't have access to multifamily investments, especially larger properties where you're spreading the risk upon, 100 or 200 units, and you're really able to, get the economies of scale of getting an on-site manager and getting a better management company and contractors, in place to help you out. So it's great to give that opportunity out. And I think it's just a wonderful way for people to diversify, out of the stock market or bonds or whatever else they're invested in. So thanks, Herb. I appreciate that.
Yeah. So a lot of times what we do is a 506B, right? And is that what you do a lot of as well?
Correct. All of our projects have been 506B offerings. And the difference in between a 506B and a 506C is a B, you have to have a pre-existing relationship with the people that are coming into your project. Plus, you can allow up to 35 sophisticated investors into your project as well. So it's a great way to do syndications. It opens up the investment opportunity to more people. A 506C, everyone has to be accredited that's coming in. You are able to, market to the masses, but that's not something that we've done at this point.
Okay, right. So this apartment investing syndication that you've been talking about, right? It's somewhat of I would say limited because it's not public, right?
Yep.
But the good thing about it is that typically we're investing in a specific deal, right? So if you as a passive investor invest in my deal, you're actually one of the owners, right? So you're a direct investment in the property, right? So it's not like you're investing in some unknown fund that may or may not be in actual real estate, right? So you actually have a chance, at least with us, you have a chance, and tell me, you can explain how you do as well, that you have a chance to go with a certain property, or maybe wait till the next one comes when it's maybe a better time for you. Do you
Yep.
explain?
Definitely.
How you do
Yep.
that?
That's exactly how we work, Herb, as well. So we do our investments on a deal by deal basis. So you have two different ways of typically doing these syndications. You can do a open or a blind fund where you're buying multiple properties and the investors are just sticking money into that fund and it gets spread across multiple properties. I think that can be advantageous, but you really have to have a ton of trust in the team and what they're investing in, because you're really going into it blind. The other option, like you had mentioned, is where you do it on a deal by deal basis. So we go out, we find a deal, say a 200 unit property. We put it under contract. We put together the business plan. We put together the investment deck, which shows exactly what we're doing to achieve our pro forma numbers. And then the investors get to really, peel back the curtain and take a look at what are the numbers, what's the market, what's the submarket, what year is the actual asset that you're buying, basically all the fine details, and figure out if that's a great investment for them or not. So I really like that way. I believe that we will continue to do our deals that way. And it's just a great way to allow investors to really get comfortable with the deal.
All right. That's great. That's good. To be able to see the deal, or at least know where it is, it provides confidence to investors as well. And here's a question from my audience, is why would I invest in apartments, and why do you invest in apartments? So could you give us a little insight there?
Yeah, certainly. So there's quite a few different reasons. I'll just touch on some of my favorites. First off, forced appreciation, one of the most important aspects of multifamily. So with apartments, you can force appreciate the value of the property by driving up the NOI, so the net operating income. So essentially you're driving up the rents, possibly driving down the expenses, and you're able to bring that value of that property up. Whereas, let's say a single family rental or even a triplex, you're really confined on the value of that property based on the competitive properties and how much they're selling for. Whereas multifamily, you can create your own value. So let's go through a little example. Let's say you find a 200 unit property that you want to passively invest in, or that you're actively buying, and you bump rents, let's say $100 per unit. So that's about $240,000 of additional income that you're increasing per year. And if you take that divided by a 4.5% cap rate, which is what multifamily is valued on, and that's pretty standard for the markets that we're buying in right now, you've just created about $5.3 million of value on that property just by bumping rents $100. You can bump other income up if you find different avenues there. You can potentially decrease the expenses. So that's just one of the many ways to force appreciate the value of the property. So very, very powerful. Like I said before, risk mitigation is huge for us with multifamily. So you're spreading your vacancy, you're spreading your bad debt, you're spreading the maintenance across many, many units instead of just a few units. So let's take a look at a couple different categories. You have industrial, which you might have one tenant. So let's say that tenant leaves, you have 100% vacancy. Might take, quite a while to fill that unit. So all of your income has dropped off the map. You have commercial, let's say you have a triple net strip center, maybe you have 6 tenants. Well, if a couple tenants leave, you're sitting at a pretty low occupancy. And then you have multifamily. If you have a 200 unit property, let's say even 20 units leave, you're still at 90% occupancy and bringing in a really good amount of income. So you're able to spread that across multiple units, which is awesome in my opinion. Beneficial debt, the debt markets right now, you're still able to get very low interest rates, interest only terms, which really helps boost cash flow, non-recourse debt, 7 to 10 year fixed loans, which we love. So that's great for multifamily. There's extremely high demand and a shortage of supply, which we love. And then, one other really nice thing is multifamily does incredibly well in economic downturns. So if you look at, during COVID, a lot of properties were hit extremely hard. Multifamily, I believe the income collections dropped by about 1.5%. So very minimal, effect on properties during COVID, which is just phenomenal. And, passive income is a huge benefit, tax benefits. I mean, the list just keeps going on and on. So those are a few of my favorite, Herb.
Thank you, Mike. That's
Yeah, you bet.
a great list. And I know you could keep going the way your knowledge base there. So yeah, thank you.
You bet.
So a lot of these things, maybe some people don't understand the terms, but the more that you listen and the more you learn, you'll be able, understand this better. And the cap rate, as you mentioned, is how the property is valued. Instead of like residential, it's valued by a sold comp, a comparable, right? But commercial is not done that way. So thanks for explaining that.
Certainly, you bet.
Yeah, it's totally based on the cap rate, which is determined by the market, right? So in the area, right? So that's really, really great information there. And one more question before we bring this to a close is, what kind of things make you believe in the deals that you invest in? And I know you pretty much covered that already, but there's a lot of deals available, right? A lot of apartments for sale or up on the market. People just trying to get what they can get out of it, right? They don't have to sell sometimes, but they want to just, to see how much they can profit they can turn by selling. So what makes you believe in the deals that you invest in?
That is a very good question. And first off, I would say, when you're passively investing, take your time, understand, who you're investing with, understand the market a bit as well. Like Herb just said, there's a lot of deals out there. It may not feel like that when you first get into it because you don't have the right connections, but eventually you will, come across quite a few deals. A couple of things that we, look at that makes us believe in a deal. Number one, the team. You want to make sure that you have a ton of trust in this team and that they're going to do a great job asset managing, that they've done a great job underwriting the property and vetting the property. And, a couple of things that you can do, you can ask for their track record. What have they done in the past? You can ask what properties, they currently own. If you're in the market, you could potentially go drive those properties and see how they look. And then in regards to the properties that they've already syndicated, that they have under their portfolio right now or that they've sold, you can ask about the performance. That's going to tell you a lot. Another thing you can do is you can ask for referrals. So who has invested with these general partners? Give them a call. Spend a little bit of time diving into that and figuring out, hey, have these investors really enjoyed working with these guys or girls? How is their communication? How has their performance been? How involved are they? And we actually have an ebook that we wrote on passive investing. So if you go to granitetowersequitygroup.com and you go to the ebook tab, you can download that for free. And it's basically 5 steps to successful passive investing. And that goes through our personal list of what we look at when we passively invest in someone's deal. So that might be helpful. Number 2, the market and the submarket, very, very important as well. Not as important as the team, in my opinion, but very important. So you want to make sure that you're investing in landlord-friendly states and cities. So take, for instance, California or New York. Very tough to get tenants out. It can take a very long time. Whereas if you're in Texas, or Tennessee, where we invest, typically 30 days or less. So you can get people out pretty quick, and the eviction process is pretty easy. Also, rent control. There's not much rent control in those states, which other states they have that. You want to look for significant business growth, significant population growth. So where are the people moving? Typically, it's across the Sun Belt, where you're going to see the most of that. And then you want to make sure, in my opinion, that you're investing in markets and submarkets that have a decent population. So you want to have a large enough population so that you can find reputable property management companies. So if you go to, let's say a city with 50,000 people, and there's no major MSA near it, it's probably going to be pretty tough to find a really good property management company. And what happens if that property management company falls apart and you need to find someone else to step in? Can you find a good backup? So We like the major, markets, Dallas, Fort Worth, Nashville, Phoenix, you name it. And, even the secondary and tertiary markets on the outskirts of those major markets, but we don't like to get too far off the beaten path because of that. And then number three is the demand in the submarket. So when we're acquiring a property, we want to see the occupancy in the mid 90s for all of our competing properties around the asset that we're looking at. And what that tells us is there's high occupancy, we're going to be able to push rents, and people aren't going to have a lot of other spots to move. So that's really going to help us, achieve our business plan. And then we also want to take a look at, have the competing properties that we're competing with already done what we're looking to achieve. So if we're looking to upgrade the units with granite countertops and stainless appliances, and we're looking to get $100 rent bump, have the competing properties already done that? And is their occupancy high? If so, we know that we can get in there and it's pretty much a proven method, and we're able to achieve our business plan regardless.
Thank you, Mike. That's a very good list there. And thanks for sharing the free ebook on your, I guess, did you say that's free to public if they go on your website?
It is. Yep. So if you type in granitetowersequitygroup.com, there's an ebook tab. You click on that, you enter in your information, and it'll send you off the ebook automatically. It's a quick read, but very beneficial if you are looking to passively invest with any group out there.
I've downloaded it myself and read it. It's very good information. So that's a good information for people looking to learn more about passive investing in apartments.
Appreciate that, Herb.
Thanks for clicking and watching this show, and come watch us on the next show.